Good afternoon, everyone. Welcome to the first release of the Financial Stability Review of 2022. This event will be hosted from Zoom onto our webcast channels and will be streamed onto the SAB's YouTube and Facebook pages. We have got various stakeholders on the line, including the media, and the governor will open the floor at the end of the presentation for questions, which will be facilitated by myself. In the meantime, the media is free to post their questions onto the webcast, and we'll forward the questions onto the panelists for answers during the question and answer session. I'll hand over now to the governor, and soon after that, there'll be a presentation from Dr. Nicola Brink. Thank you. Governor.
Thank you very much, and thanks for joining us to this first Financial Stability Forum of 2022. The intention of the Financial Stability Forum is to strengthen public awareness and debates on issues relating to financial stability in South Africa and on how global developments could affect domestic financial stability. This forum takes place twice a year to mark the release of the Financial Stability Review. With the promulgation of the Financial Sector Regulation Act, the SARB was given the statutory mandate of protecting and enhancing financial stability. I would like to emphasize that although FISRA assigns a lead role to the SARB in protecting and enhancing financial stability in South Africa, the Act also empowers several other financial sector regulators to support the SARB in pursuing this mandate, or may I say, places a responsibility on those other financial sector regulators to support the SARB in pursuing financial stability. And these authorities include the National Treasury, the Prudential Authority, the Financial Intelligence Center, the Financial Sector Conduct Authority, and the National Credit Regulator. Inter-agency coordination and cooperation are therefore critical in pursuit of financial stability. The previous FSR was in November last year, and in that we had identified that systemic risk in the South African financial system has decreased marginally, prompting a slight improvement in the outlook for financial stability. The South African financial system has displayed a relatively high level of resilience under challenging conditions during the period under review. The largest shock to the global financial system during the period under review was caused by Russia's invasion of Ukraine earlier this year, with the ensuing war resulting in numerous disruptions across the global economy. In an environment where the global economy was just starting to recover from disruptions of the COVID-19 pandemic, the war resulted in renewed volatility in global financial markets, further disruptions of global supply chains, and high inflation outcomes and expectations. With global growth forecasts lowered and monetary policy tightened in reaction to high and rising inflation in several advanced economies, the risk of global stagflation has become more prominent, with implications for financial markets, particularly those of the emerging markets. Domestically, the pertinent financial stability vulnerabilities that we have identified had been the high level of government debt and financial sectors exposure thereto, what we have characterized as the sovereign banking nexus. And this is taking place against the backdrop of weak domestic growth, the risk of a global stagflation, and tightening financial conditions. In addition to this, of course, there are the operational risks, mainly from a cyber perspective, which are continuing to linger and potentially threatening to disrupt financial institutions and financial markets infrastructures. Of course, the COVID pandemic is still very much here with us, and we experience new waves that we have to be dealing with. Fortunately, the countries that are having high levels of vaccinations have also demonstrated that they are better positioned to withstand the impact of COVID-19. South Africa went through a mutual evaluation assessment, and the report that comes from there might be identifying deficiencies, and those deficiencies which have to be dealt with in a timely manner, and failure to deal with those could actually put the financial sector at risk. Over the medium to long term, financial institutions remain vulnerable to physical and transition effects of climate change, and such as the South African financial sector, as the world moves towards carbon neutrality and having to take cognizance of the impact of a just transition and the increasing costs of short-term insurance and the potential unwillingness by insurers and reinsurers to provide cover against climate-related risks. In this edition of the Financial Stability Review, we do identify and have an in-depth discussion about the unprecedented decline in the liquidity levels in the South African government bond market since the start of the COVID pandemic. As the SAP, we have taken various steps to restore and maintain market functioning since the onset of COVID-19. Thus, the declining liquidity in government bond markets, which has prevailed beyond the initial shock, is a point of concern. Should this illiquidity persist, it would make the domestic financial system vulnerable to higher volatility, sharp price adjustments, and an increased cost of funding. When considered alongside the bank sovereign nexus, as we had identified in the 2021 first edition of the Financial Sector Review, liquidity in the South African government bond market will be monitored more closely from a financial stability perspective. In addition, this edition also focuses on the role of the SARB as a resolution authority for all designated financial institutions and the establishment of the Corporation for Corporate Deposits as a subsidiary of the SARB. We have identified the SARB about the Corporation for Deposit Insurance to actually say to you, to South Africans, that the South African financial system is now not just more resilient, but we now would be having an explicit deposit insurance, which means that depositors are protected. We have always had depositors protected, but that protection had actually been implicit. What the establishment of the Corporation for Deposit Insurance would do is that it would become more explicit and actually operate more like an insurance scheme. On the panel today, we have got our deputy governors, Deputy Governor Kuben Naidu, who is now responsible for financial stability, Deputy Governor Fundi Chasivana, who is also the CEO of the Prudential Authority, Deputy Governor Rashad Kasim, who is responsible for financial matters. I would also be inviting Nicola Brink, who is the head of the Financial Stability Department, to walk us through the presentation. And we also have Jack Waters, who is heading the Resolution Planning Division in the Financial Stability Department. Nicola, over to you to do the presentation.
Thank you very much, Governor, and good afternoon to everyone. I'll be doing the presentation. Zayanda will share it and help me navigate through the slides. It's a pleasure to present this edition of the Financial Stability Forum report at this forum. I trust that you'll find it interesting. I think before I start, I would like to acknowledge all the staff that contributed to it in various ways, both in content, editing and design. I would also like to introduce our brand new editor, Herke Stein, who really hit the ground running with his latest edition. I just want to check with Ziyanda whether she's going to put the presentation up for us. It's coming. Great, thank you. So we can move to the next slide. The first 5 parts of my presentation will summarize the various aspects of our financial stability assessment for South Africa. The last section will focus on the thematic topic that we discuss in Chapter 2 of the publication, namely the introduction of a new resolution and deposit insurance framework. This framework closes important gaps in South Africa's financial safety net, and that's why it was also the inspiration for the pretty cover of our FSR this time round. Next. So the key messages in the FSR is taken directly out of Chapter 1. In essence, and overall, our assessment of the financial system is that it remained resilient despite challenging conditions and underlying vulnerabilities. In aggregate, financial institutions met their prudential requirements and there were no material interruptions of financial services and activity. While we point out some sectoral vulnerabilities in the publication, these are not systemic at this stage and are being monitored. Ziyanda, you can move on to the next slide.
She seems to be going backwards instead of forward.
Apologies for that, Nicola. Technical glitch.
No problem. We are now at the one that starts with actions by the SARB. I'll continue in the meantime. This is a text slide. So as the Governor indicated, the Financial Sector Regulation Act requires the SARB to take appropriate actions to protect stability if we detect any buildup of excesses or instability. The SARB continued to do work with the Prudential Authority on this bank sovereign nexus that we highlighted last year. Then, because financial stability is a shared responsibility, we collaborate closely with other regulators and authorities who are members of the Financial Sector Oversight Committee, or FSOC. We published several discussion papers on the new resolution and deposit insurance framework, and work is continuing to implement those frameworks. Then the Financial Stability Committee kept the counter-cyclical capital buffer at 0%. The CCYB is a macro-prudential tool. It's designed to curb excessive credit growth or bank credit growth to be specific. But in the absence of excessive growth in bank credit, there was really no need to increase the buffer. Next. Governor, I think there's a problem. Zianda, this is not the right presentation. I think you were on another presentation that we had earlier. So, apologies for that. So that's the right one, and we are starting with global developments. Just 2 slides down. Yes, stop. There, next one. So the global economy was still recovering from the effects of the pandemic when Russia invaded Ukraine. That invasion and the war that followed triggered renewed volatility, disruption of supply chains, and also sanctions. This was combined with further flare-ups of COVID in various parts of the world, and China, among others. Well, China had severe lockdown rules. Already high inflation in several advanced economies increased further to 40-year highs, and the major central banks reacted by increasing interest rates and in some cases announcing intentions of quantitative tightening. Volatility was particularly high in emerging market currency and equity markets. We expect material spillovers for emerging markets, among others, through the capital flow channel and exchange rate channel. Next. These composite indices of financial conditions in the EU, US, and Japan give an indication of the ease and cost with which funding can be obtained. If the index goes above the 100 level, funding becomes more expensive and harder to access. The graph shows that funding conditions in these countries are still relatively loose, at most neutral in the EU, but there have been significant tightening in the EU and US, among others, since the beginning of 2022. Next. Increases in interest rates have a much more severe impact in an environment of high debt levels. The blue bars in this graph show how debt levels globally have steadily increased over recent years, but especially since the outbreak of the pandemic, as governments stepped in to support their economies. Global debt reached a record high of $303 trillion at the end of last year. The global debt to GDP ratio has declined from its peak of over 360% in 2020 as global GDP recovered, but the amount of global debt is still about 3.5 times the size of global GDP. Next. This graph shows a number of volatility indices that Bloomberg publishes for various asset classes. Volatility for all the riskier asset classes have increased significantly since the previous FSR, especially so for emerging market equities, emerging market currencies, US treasuries, and derivative markets. The only market that remained fairly stable was gold, which of course is a safe haven asset. Next. We now move to the SARB's view on South Africa's financial stability conjuncture for the 6 months up to the end of May, as well as the future outlook for financial stability. Next. We note that financial institutions operated in a challenging, low-growth environment. The pandemic had a disproportionate impact on low-income earners, thus increasing an already high degree of inequality. Adding the rising cost of living to this situation, the debt servicing capability of ordinary households may come under pressure. Furthermore, it increases the chances of further incidences of social unrest, which can be very costly for the financial sector. South Africa has limited trade and financial links with either Russia and Ukraine, but the spillover effects of global developments will have an indirect effect through various channels, such as growth, inflation, and investor sentiment. As mitigating factors, high commodity prices supported investor sentiment and the exchange rate of the rand for much of the period under review, and inflation outcomes in South Africa have so far been relatively moderate in comparison with other parts of the world. Next. The Reserve Bank compiles a financial stability heat map, which gives a snapshot of domestic financial stability conditions against historic averages. The heat map is a backward-looking tool. It is based on actual outcomes of a range of indicators. In the back of the FSR, we have all the indicators that we use for this heat map, if you are interested. We see it as a starting point for deeper and more forward-looking analysis. Overall, financial stability conditions have improved since the height of the COVID shock in 2020, as you can see in the the reduction in red parts towards the end of the heat map. However, there are some sectors that experience strain, and I'll focus my comments on these, starting with commercial real estate, which is turning slightly orange. It is experiencing moderate strain compared to historic trends, mainly because rental occupation has not fully recovered and as a result of the work from home arrangements. The banking sector concentration, which shows red in this period, reflects the concentration of bank assets in mortgages and in government debt, making them vulnerable to sharp adjustments in either of these assets. The insurance sector experienced strain from the pandemic, from severe climate events, and damage from social unrest. Household indebtedness remains high despite some moderation, and so does government debt. Next. Whereas the heat map is backward-looking and largely based on numerical indicators, the risk and vulnerability matrix, or the RVM, is a forward-looking qualitative assessment of key risks to financial stability in the foreseeable future. Let me explain some of the metrics. The horizontal axis gives an indication of the time frame over which a risk may materialize. The vertical axis indicates the likelihood of it materializing, and then the color of the block gives an assessment of the financial system's vulnerability should the risk materialize, after taking into account any mitigating effects. We've included for the first time the full RVM table in the FSR with all the detail, and that may be useful for those interested in a more in-depth analysis. We still see the high level of government debt as the highest residual vulnerability. That's the red block. There are some mitigating factors, like the fact that most of the debt is denominated in rand and the government's commitment to fiscal consolidation. However, the sheer size of the debt and the concentration of exposures of domestic financial institutions to government debt makes the financial system vulnerable to episodes of market dysfunction or sharp price adjustments in government bond prices. Slow and inequitable growth is another lingering vulnerability that makes the operating environment for financial institutions challenging. In order to remain profitable in an environment of lackluster growth, financial institutions may be tempted to embark on business models that are not always resilient to periods of stress. COVID is not yet over, but vaccinations are now readily available and resistance to vaccination has declined. Measures to contain the spread have become more targeted. Therefore, while we are aware that there is likely to be more flare-ups of more variants, we think the residual vulnerability of the financial system is less than at the time of the previous FSR. With rising inflation and lower growth expectations globally, there is a risk of global stagflation. Despite mitigating factors, such as the flexible exchange rate of the rand and exposures on foreign exchange limits, or limits on foreign exchange exposures rather, on financial institutions, there's a moderate residual vulnerability linked to the effects of low growth, but also stemming from lighter regulation in some parts of the financial system, a high level of interconnectedness and concentration in the financial system, and the risk of capital outflows. We note a new risk that can materialize in the new term, namely the consequences if some of the unfavorable findings of the Financial Action Task Force, or FATF, mutual evaluation are not adequately addressed. The FATF assesses countries' ability to detect, prevent, and react or prosecute money laundering, financial crime, and terrorist financing. The mutual evaluation found some areas of either technical non-compliance or ineffective application of controls. Structures have been established domestically to deal with these in time, but if we fail to do so, and South Africa is grey-listed by FATF, our financial institutions will be subject to more intense scrutiny internationally with higher transaction cost. The risk of disruptive cyber attacks is always present, but it has increased with the Russia-Ukraine war. Additionally, there's a greater chance of global financial infrastructures coming under attack. Thus, we increased the residual vulnerability from the previous FSR. Lastly, the physical and transition risk from climate change is already present and is likely to last well into the longer term. Next. In Chapter 3 of the FSR, we delve into more detailed sectoral analyses to complement the higher level risks identified in Chapter 1. The following couple of slides highlight some of the main themes. In the financial markets section, there's a write-up about the declining liquidity in the South African bond market. This is relevant for financial stability because deep and liquid financial markets enable financial institutions to raise liquidity in times of stress. And it also provides opportunities for diversified funding and investment portfolios, thereby reducing overall systemic risk. Additionally, the bond yield curve serves as a pricing benchmark for other market rates, making effective price discovery in a liquid market essential. The South African bond market is dominated by government bonds. Since 2019, there has been a market decline in the liquidity. Here I show the transaction volumes, but in the FSR itself, we also discuss other indicators of liquidity. In our assessment so far, the decline in liquidity is partly caused by lower foreign investor participation and the greater inclination of domestic investors to adopt a buy and hold strategy in an environment where government bonds offer attractive yields. This trend is not unique to South Africa, and it is too early to tell whether it is structural or transitory, but it is definitely something that the SARP will monitor going forward. Next. In the banking sector, both credit growth and credit quality are recovering at a moderate pace. Profitability has been holding up, and overall capital adequacy remains healthy. However, there are pockets of strain. The non-performing loans of smaller or non-SIFI banks, that's the pink line, are elevated as a percentage of their total loans and advances. And as a group, their profitability is also low, that's the light green line. However, in rand terms, the orange bar, the impaired advances of non-SIFI banks are small in relation to the total sector, thus limiting systemic risk. Next. In the insurance sector, social unrest, extreme climate-related events like the floods in KwaZulu-Natal, hailstorms and fires, as well as the effects of COVID-19 in terms of job losses, business interruption and death claims, hit both the life and non-life insurance sectors quite hard. However, except for Sasria that had to be recapitalized by government, the rest of the sector remains adequately capitalized and in aggregate still meet prudential requirements. Next, risks to financial stability can also originate in the non-financial sector. Therefore, we assess the sector for any build-up of imbalances or vulnerabilities that could spill over into the financial system. Next. Starting with the non-financial corporate sector, we observe an uneven recovery from the effects of COVID-19. Overall, as you can see on the left-hand graph, there was very subdued demand for credit from corporates, and on the right-hand side, an historically high savings rate. This is good for credit risk, but it could be bad for bank lending business, investment activity, and future growth prospects. Next. The aggregate balance sheet of households appear healthier, as you can see on the left, when measured in terms of aggregate real net wealth and income. However, there are underlying vulnerabilities relating to unemployment, the unequal impact of COVID-19, highly indebted households, and rising costs of living, as had been highlighted earlier in the presentation. Next. Financial stability risks can also emanate from the real estate sector and spill over into the financial system if the real estate sector overheats and becomes over-leveraged. In the residential property sector, house prices increases moderated and mortgage lending recovered to pre-COVID-19 levels. We mention in the FSR a slight loosening of mortgage criteria, with more mortgages being granted at loan-to-value ratios above 100. That means the loans are larger than the value of the underlying collateral. However, despite some pockets of stress, we don't see a material financial stability risk in the current state of this market. In the commercial real estate sector, on the right-hand side, rental occupation remains well below pre-COVID levels, with material differences among economic sectors. For example, retail properties are the worst affected, while storage facilities are doing fairly well. Overall, non-performing loans on commercial mortgages are well contained. Next. The outlook for government debt has improved. It is now expected to peak at 75% of GDP, down from the previous 80.5%. As mentioned before, despite an improved outlook, the high level of debt and committed expenditure items still pose a risk to debt sustainability. Next. This brings me then to the thematic focus, the resolution and deposit insurance framework. Next. The enactment of the Financial Sector Laws Amendment Bill introduces a strengthened resolution framework and deposit insurance as key elements of the financial safety net. While prudential regulation and supervision aims to prevent failures of financial institutions, the resolution and deposit insurance framework aims to minimize the impact of a failure, should it occur, on customers, on the rest of the financial system, and on the economy. In terms of the new Act, the SARB will become the resolution authority and be responsible to manage the orderly resolution of failing institutions. And this goes for both small institutions and large ones. It should be noted that the provisions of the Act will actually only become effective according to an implementation schedule that is still to be agreed and approved by the Minister of Finance. Next. In line with international standards, the new Act introduces additional powers that will make a wider range of resolution options possible. It will also improve clarity and reduce reliance on government funding. Some of the new powers are the ability to recapitalize a failed institution through bail-in, the power to restructure an institution, and general powers to limit contagion effects, ensure the continuation of critical functions, and take control of a failed institution if necessary. In Chapter 2 of the FSR, there is a full write-up of these new powers, explaining how they might be used. And then the Act also makes resolution planning mandatory, and this will be done for all designated institutions. Next. The main objective of deposit insurance is to ensure that depositors have access to their funds in the event of a bank failure, and to ensure that they have fast and certain access to their money. An important change brought about by this legislation is that this protection will be funded by the banking industry itself, not by government. There will be a coverage limit of 100,000 Rand per depositor per bank, and this fully covers more than 90% of depositors to their full amount of deposits. The Deposit Insurance Fund will be administered by the Reserve Bank in a subsidiary, the Corporation for Deposit Insurance, or CODI. And then for a deposit insurance scheme to be successful, there has to be a high degree of public awareness about its existence and the protection that it provides, which is partly why we chose it as a theme for this publication and include it in this presentation. I'm summarizing. There were no material episodes of financial instability during the period under review, despite some vulnerabilities that remain and that could be exacerbated by adverse developments. Prudentially regulated financial institutions remained resilient and adhere to prudential requirements. The SARB is closely monitoring developments and stands ready to adjust policy if necessary. And with that, Governor, I hand back to you. Thank you.
Thanks, Nicola, and thanks. Eventually, you did find the right presentation. We open the floor for questions, and Ziyanda will field the questions and push them through. I will take all the simple questions and put all the difficult questions to members of the panel. Ziyanda?
Governor, I will be responsible for the questions.
Okay, a strong man. Go ahead.
So far, I've got 3 questions. We expect more to come. The first one comes from Atwell Dlamini, who is from Alliance News. His question is, what does stagflation mean for South Africa specifically, and how serious is this risk? I'll repeat the question. What does stagflation mean for South Africa, and how serious is the risk? The second question comes from Naledi Ngcobo from SABC Radio. The question is, how big is the contribution of household debt to South Africa's level of growth? How big is the contribution of household debt to South Africa's level of growth? The third question I have comes from Londiwe Buteles from Fin24. The question is, has Ubank's curator received offers from new investors willing to fund the bank to help it with its capital adequacy challenges? And how much investment, more or less? And does UBank need to bring its capital adequacy ratio to the required level to get out of curatorship? I'll repeat the last question. Has the UBank curator received any offers from investors willing to fund the bank to help it with its capital adequacy challenges? How much investment? And does the bank need to bring its capital adequacy levels to the required levels in order to get out of curatorship? Thank you, Governor.
Thank you very much, Mr. Dlamini. The first question that had to do with the stagflation and what it means for South Africa, I think that it's first to understand what stagflation is, which is rising inflation and very low levels of growth or declining levels of growth. And in its most extreme, the economy that is contracting and yet faced with high inflation. That poses a dilemma for any central bank. At the moment, the risks to South Africa are not South Africa per se facing stagflation, but it is rather the risk of stagflation in advanced economies that would pose a risk for South Africa. And so, if the advanced economy, let's take the US, was to get into stagflation, the US Fed would be forced to choose between dealing with inflation and trying to continue to support growth at the time when inflation is rising, which then brings into the fore that the only way thus that the US would have to do to bring down inflation could be to throw the economy deeper into a recession in order to deal with that. What this says for us is, now we know that it doesn't follow that living with high inflation would lead to growth. Because stagflation means exactly that you are having rising inflation and yet growth is declining. It poses a dilemma for central banks. And as we know, and as we have seen historically, faced with this dilemma, central banks end up having to tackle inflation, restore price stability so that growth could eventually be rebuilt in a sustainable way. If the advanced economies were to fall into stagflationary conditions, and they are having to deal with inflation through tightening monetary policy, like they have started doing, what you would then face is tighter global financial conditions. And with tighter global financial conditions, emerging markets will struggle to access global finance. And if they struggle to access global finance, there is bound to be a repricing of financial assets, and particularly those of emerging markets. And that is most likely the most pronounced manner in which it's going to happen is through a realignment of exchange rates. And that realignment of exchange rate that would take place thus would mean that the emerging market exchange rate would depreciate. And faced with depreciating exchange rates, and depending on the pass-through of the depreciation of exchange rates to inflation, emerging markets themselves would be faced with a similar dilemma. Because what we normally do is to always try and see through the shock and then wait for the second round effects to indicate that they are likely to materialize. You do not have to wait for them to materialize. All that is important is an assessment that suggests that they are likely to materialize, and a risk-based monetary policy would thus react to that. So that is the first channel that we use. The second channel then poses an even bigger problem, because actually all emerging markets are small open economies. And as small open economies, we depend on foreign demand. But if the advanced economies are in a constructionary phase, that means that global demand is not there. And faced with tighter global financial conditions, depreciating currencies that might be feeding into inflation, the emerging market economies themselves would then have to tighten policy. Now, faced with prospects of a stagflation and faced with the prospects of a rising inflation, the question that always comes is that of timing. And at the moment, there is a big debate in the policy discourse about whether the advanced economies didn't leave their actions too late. The jury is still out. What we do know is that there is a significant number of emerging markets, including South Africa, that started acting last year based on the inflation outlook. At the moment, we think doing relatively well compared to developed economies with respect to the containment of inflation. Our growth is not spectacular, but there is growth nonetheless, and we are still yet to recover from recover to the levels that we had been at pre-COVID. So that is what the stagflation would actually mean for South Africa. Reduced global demand, which means that the demand for our goods and services globally has declined. At the moment, we are less vulnerable than we were getting into the COVID crisis because we are running a current account surplus. But our own base case, is that the current account surplus would decline into next year, and that by 2024 will actually return to zero. It is a slightly better picture than the one that we had at the time of the March monetary policy meeting. But that is what we are actually faced with, that there would be reduced demand, there would be a realignment, there would be a tightening of global financial conditions, which means the accessing of capital is going to become more expensive, and there would be a realignment of exchange rates. And in the case of the emerging markets, including South Africa, this realignment of exchange rate would mean actually necessarily a depreciation of the currency, which could feed into inflation. Add to that the current geopolitical tensions, which have led to a rise in fuel prices and food prices. And you have got a very difficult dynamic that we are actually facing. It just makes central banking even more challenging than it had been in the recent past. So that is what we faced with. Naledi,
Governor, sorry, Naledi updated your question, so I don't know if I should.
Oh no! Can I post your questions? We are live. Can I deal with your question, please?
Okay.
Naledi asked a question about the contribution of household debt to the South African economy. Now, let's put it this way. You can't borrow your way out of troubles. What matters for South Africa and economic activity is the level of household consumption expenditure. Households consumption expenditure makes about just over 60% of GDP in South Africa. So we watch household consumption expenditure closely, and a key driver of household consumption expenditure is personal disposable income, and to that you can also bring the wealth effects that come from a rise in the financial assets or real assets held by the households. So in a place where you have rising house prices, rising share market, and all of that, and households feel richer, the households have got the wherewithal to spend and thus continue to support household consumption expenditure. From a financial stability perspective, it becomes an issue when household consumption expenditure is fueled by debt. And so when you ask the question of the importance of household debt to GDP growth, that is where we then come from. To the extent that household expenditure remains robust and is driven by disposable income and wealth effects, that is good. But if it is fueled by debt, it could become a problem. At the moment, yes, the households do feel a bit of pressure on the debt side, but there isn't evidence that suggests that the recovery of household expenditure has been fueled by debt. But we do watch that. Closely, and Samson, we can always come back and see what Naledi has updated. Has the curator of UBank received bids? I'm not the curator we are not the curators of UBank. That question is best answered by the curator of UBank. As we were taking UBank into curatorship, there are things we needed to understand. We have been watching the issue of African Bank from as early as 2011 to 2012 and had engaged with successive boards of UBank. So any notion that would suggest that the issues of UBank arose the weekend before UBank was put into curatorship are not based on facts. UBank's business model had been a subject of discussion with the regulators prior to the creation of the Prudential Authority. Those engagements took place with the Office for Banks in the South African Reserve Bank. What we were in no doubt about was that UBank needed capital. And capital can only come from shareholders. The shareholders of UBank throughout that period, throughout all this number of years, had demonstrated that they didn't have the capital to put into UBank, or if they had the capital to put into UBank, were not keen to put the capital into UBank. Our take is that they didn't have the capital to put into UBank throughout this period. In the past 2 years, before UBank was put under curatorship, we put UBank under supervisory intensity. What does supervisory intensity mean? It means that we require even more supervisory resources to oversee the bank. On the bigger scheme of things, UBank is not a systemic bank, but UBank provides an important service to mine workers and their families. And as such, we had to pay particular attention to the health of UBank because it was a custodian of the savings of a very vulnerable section of our population. And so we put UBank under supervisory intensity. There were governance issues as we had raised, and we have seen the board of UBank change now. We have also seen the executives, the senior management of the bank change throughout this period. We were watching this closely. And last year, there were other requests that they need to recapitalize the bank. As this bank was going into curatorship, its cost-to-income ratio was over 100% because they had been making losses. That means that they had been eroding capital. And because they had been eroding capital, they needed to bring in more capital because the protection for depositors has to do with the amount of capital that exists within the bank. And so let's get this clear, that what we are faced with here is not a liquidity issue, because from a liquidity perspective, UBank has got adequate liquidity coverage ratio and would be able to meet the calls by depositors as and when they fall due. But this is a bank that had been making losses, had eroded its capital adequacy dropped to as low as 3%, and the curator had to get in there to assess the full extent of the hole that is there. Into the curatorship around that weekend, it was clear that they had to get the shareholders with deep pockets to come in. Unfortunately, last year there was a proposal on the table that eventually the shareholders of UBank rejected. It would have put capital into UBank. And so the notion that or the narrative that is going out there, which is just plain wrong and not based on facts, that says that UBank would have been and could have raised capital in 24 hours that they couldn't raise over a period of 2 years. It's not backed up by facts. And so this is what we were faced with. Our responsibility as the regulators, as the resolution authority, is to protect the interests of the depositors. And the interest of the depositors gets protected because there is capital in the bank. UBank had eroded its capital, hence it had to be put under curatorship. Curatorship is not necessarily death for a bank. African Bank was put under curatorship and it's recovered. It's there. It's a new African bank and it's doing well. A curatorship is meant to take an institution in trouble into an intensive care unit, so to say, in the form of curatorship, and nurse it back to health, provided it is not terminally ill. The curator will make that assessment and tell us whether this institution could be nursed back to health. And as I have said, this is an institution which has got liquidity, and to nurse it back to health, we need shareholders to inject capital. And that process will then have to be run by the curator. And it's very important that the curator assesses those options and approach us as regulators for approval, and we will take it from there. Samson, what was the update from the lady?
Yeah, Governor, you addressed the first part of the question. The next part was, does the FSLAA replace curatorship entirely? What will be the material differences between the role of the sub versus the PA in handling failing financial institutions under the new Amendment Act?
I do not understand. So this question now has got nothing to do with household things. This is a new question.
Yeah, so the first part of the question dealt with household debt servicing costs. Then he or she added this new detail.
Okay, so now this new detail is saying what?
Does the FSLAA replace curatorship entirely? What will be the material differences between the role of the sub versus the prudential authority in handling a failing financial institution under the new Amendment Act?
No, curatorship is still there as a form of regulatory or supervisory action. The amendments that have taken place, which was to create a corporation for deposit insurance, is converting what South Africa had, which was an implicit deposit insurance, which meant that South Africa didn't have any deposit insurance. But when a bank failed, the South African government stood good for the depositors, and it used to do so to the tune of 50,000 rands. That is what happened with Sambo, that's what happened with Regal Bank, with the other institutions that went into curatorship. That is also what happened with VBS. The fortunate thing for the depositors of VBS was that their curatorship of VBS came in at the time when we were advanced in raising the extent of depositor protection from 50,000 to 100,000. At a depositor protection of 100,000, we would be able to cover 90% of the retail depositors in the country. So it is a significant coverage. The fact that we have got deposit insurance does not mean that a failing institution cannot be put under curatorship. Because as I said, curatorship is meant to nurse a sick institution back to health. And so curatorship will always be there as a resolution instrument. So the fact that you have got deposit insurance does not mean that curatorship cannot take place. Colleagues, is there anything that anybody wants to add so far on the questions that we have dealt with? Nicola, Jack, anybody on deposit insurance?
Chair, there's a couple of other aspects of the financial sector regulation, financial sector laws amendment bill around resolution that does give both the SARB greater powers and authority. It also introduces this concept of bail-in. It introduces different tiers of debt, some of which are bail-inable. Perhaps Nicholas should run through quickly what the 2 or 3 key changes. What's different with the resolution bill now than we didn't have before the law was changed. Nicola?
Thank you, Governor and Kiben. Yes, I think bail-in is an important new tool that's never been available. So bail-in basically means that the resolution authority has the power, and this has been designed mainly for big banks that cannot be allowed to close even if they fail, even if they don't have enough capital. Because of their size and complexity, we have to keep the critical functions running. So, but the bail-in power makes it possible to put the cost of recapitalization directly on shareholders and some pre-identified creditors. So you recapitalize the institution from its own balance sheet, and those who benefited from profits in good times then also pays for the recapitalization in bad times. It's a significant change from what we saw in the financial crisis globally, where governments and taxpayers actually had to recapitalize these big banks. So I would say that's probably one of the main changes. Then we also have a change in credit hierarchy. So up to now, there was no clear preference for depositors if a bank is liquidated. This changes, and now there is clear preference for covered depositors. They will receive an immediate payout from the deposit insurance fund, and then in liquidation, in the event that the bank goes to liquidation, the deposit insurance fund will be replenished. It will have a preferential standing in the credit hierarchy. And then, as we set out in the publication itself, there's a number of, we'd say smaller, it's smaller maybe in terms of the interest it elicited, but it's not smaller in terms of implication. There's some things that become much more easy to do to restructure an institution to make it more viable, or to make it more attractive for a takeover. That is something that can be done currently, but there are some frictions in the new regime. For example, if an institution enters resolution, we won't need shareholder approval for some of those transactions, which may just make it possible and opens up the options. I just want to also comment on the issue of curatorship. We have, in principle, curatorship under the resolution framework. However, the execution thereof will fall under the Reserve Bank. So curatorship in terms of the Banks Act disappears. We gave it another name of appointing an administrator. That's just to avoid confusion, but it's essentially the same thing. There to help manage a bank back to health, if possible. There's a slight technical change also in that the legal powers will vest in the Reserve Bank directly and not in the curator as currently. But in essence, it's, as the Governor said, the same type of arrangement with the same purpose. I think, Kiben, that's more or less from the top of my head, the main things. The whole purpose of these new powers is to ensure that the financial system continues to function smoothly when there's a failure, even of a big institution, that there's no longer an immediate reliance on government funding, and overall that there's, if you invest in bank shares or bank debt, that you know exactly what risks you are exposed to, and that risk is fully priced into the paper. Thank you.
Governor, I think there's been a lot of interest on this issue of curatorship and the corporate, the CODI. I think the last two questions that I'll raise on that, one comes from Paul from Sowetan, who talks about Ubank, and she says, last week when announcing Ubank was placed under curatorship, the South African Reserve Bank, mentioned that corporate governance was one of the issues. So she is asking that that point be elaborated on. And on the Corporation for Deposit Insurance, the outstanding question comes from Londiwe Buteles from Fin24, who asks, when is the Corporation for Deposit Insurance going to start operating? And a follow-up question on that was, what happens to the remainder of the deposit that is not insured? I think that will then close the questions on the Corporation for Deposit Insurance and the issue of your bank. Thank you.
On the timing, there had been a promulgation, and I think that Nicola can always come in and give the exact date. Let me put it to you this way in terms of what happens with the rest of the deposits that is not insured. Think of it. If you have insured your car or your house and there is an excess, the excess is what you are responsible for. The insurer will pay for the claim. And so we are saying we will insure the deposits up to 100,000. That means that anything above 100,000 per depositor per bank, get that one clear. So even if you had 2 accounts in the same bank and you are one depositor, you are covered for 100,000. If you had 110,000, we will only make good 100,000. The other 10,000 above that, you would lose. But as we said, 90% of the depositors in the South African banking industry do not have more than 100,000. They would be adequately covered. We have done this simulations to try, if we take it up to 200,000, it doesn't improve much. So this 100,000 just seemed to cover this. And a Fundi can always come on the corporate governance issues. But I think that as the questions were coming, and one of the things that I had sort of like picked was a question that says that this bank deals with mine workers. Why didn't you talk to the mine workers unions on this? Well, we don't regulate unions. We regulate banks. And as regulators, we engage with the bank's management and the bank's boards. That is who we interact with, not the other interest groups. Even if they come, there are things we cannot discuss with them because there are matters confidential between the regulator and the regulated entity. We have had the issues of governance, and maybe I would rather prefer that in our engagements, now that this bank is under curatorship, that we would deal with all of the stakeholders, because now the bank is under curatorship, is being taken care of by the curator. To be clear, that in our regulatory space, we deal with the management, we deal with the boards, and to the extent that there is a need for capital, we might ask the shareholders to put capital. And if they can't, we say to the board and the management, find another shareholder who would put capital. I must say that we have really, as the South African Reserve Bank and as the Prudential Authority, did our utmost best over these years to nurse this bank so that it survives. But we do not put the capital in the banks. That's not the job of us as regulators. It is the responsibility of shareholders to put capital in a bank. And this bank, we had repeatedly argued, it needed capital. And in our engagement with the board and the management of the bank, we said, get somebody else to put capital. And as I had said, there was someone prepared to put capital last year. It was rejected by the shareholders of Ubank. And it is their decision, not ours. The only thing we can argue about is we want more capital. And that capital had to be put in. And it is not the responsibility of the South African Reserve Bank to put capital into institutions. Fundi?
Thank you, Governor. Let me start on the issue of governance. I think that we should understand when we are discussing issues that are specific to an institution, we're not going to go to the level of detail that I think some others would like to hear. But just to give color on some of the governance issues, firstly, there had been loss of key staff within the bank. The second issue is that the board itself is not properly constituted in terms of having majority, or it did not have majority independent non-executive directors. The third issue is that there were a number of unresolved audit findings within the bank. And I would say that those would be the key issues that one would have to take into account from a governance point of view. And these are things that we had been discussing with the bank over time. The bank is run by its management team. The board has got a critical governance role in ensuring that the bank executes and complies with the regulatory provisions. So when we give the bank a license, the bank basically has an obligation of ensuring that there will be sufficient management within the bank to protect the deposits that it will receive, and that there will be sufficient governance structures to enable the bank to comply with its license conditions. So those are things that are very important. Just finally on the curator of Ubank, I'll just say a few words here. So the curator has been in the bank for about 7 days now, 7 business days. It's important to understand when a curator comes into an institution, the first thing that the curator needs to do is to understand what is the financial position of that institution. The second thing is what is the operational position that the institution finds itself in. We have highlighted as the central bank, and this is a very clear mandate that the curator has, is to ensure that the interests of the depositors are going to be protected. We've also highlighted that because there are no major liquidity concerns that had been identified so far in this bank, the focus should be on ensuring that we get adequate capital in the bank. So the curator will in due course communicate once he gets to a certain position on where the position is around finding additional investors for the bank. Let me stop there, Governor.
Thanks, Fundi. Samson, any other questions? Are there no questions, or are you muted?
I've got a few more questions, Governor. The first one comes from Monique Fanek.
I don't know how many more. Shall we take this as the last round, please?
Yeah. So a question is, will the central bank start buying bonds again if the liquidity situation persists? The second one comes from Jacobus Rousseau. The organization here is not clarified. He's saying, can you please explain the apparent data gap over the initial period of the heat map for the banks and insurance companies. The next one comes from Sikaro Mapena from Nedbank. The question is, given the liquidity issues that the SARB has noted in the South African government bond market, is the SARB ready and willing to provide liquidity? And if so, under what conditions would it do so? The last one comes from Elena, who is from Rand Merchant Bank. A question is, the Financial Action Task Force Mutual Evaluation Assessment, what specific steps are the SARB and the government taking to avoid South Africa from being placed on the grey list? Any timelines for those actions? Thank you.
Thank you very much. Kuben Fundi, one of you deal with the FATF question, and then Nicola and Jacques, can I go straight? I didn't understand the question about the apparent data gaps on the heat maps, what it meant, if you understood that, if you could deal with that, and then I will take the last question on liquidity.
Fundi, you want to go or should I?
Yeah, you can go ahead, Kuben.
Thanks. South Africa had what's called a FATF mutual evaluation starting in around 2019, 2020, and concluded with a report in October 2021. South Africa as a country did not come out too well from this report. There were several areas of our strategy to fight money laundering and terrorism finance that were found not up to FATF standards. Now, this is an extremely broad set of issues. It covers banking, insurance, diamond sales, car sales, real estate, but it also covers the prosecution, the investigation and prosecution of people who commit money laundering or are engaged in terrorist financing. So the remedial actions recommended by FATF are extremely wide-ranging. They cover not only the Reserve Bank as a regulator and the Financial Intelligence Center, the Financial Sector Conduct Authority, but an extremely wide range of public sector institutions and in some cases private institutions for mediation. From the Reserve Bank's point of view, we're working incredibly hard to address the areas where we think we need to improve on. Risk-based supervision of AML CFT was one of those areas. Getting the banks to have a standard approach to beneficial ownership when they onboard customers was a second area that we're working quite intensely on. We're confident that we'll be able to mediate the issues that are for our attention, but I do think that there are broader problems in the country that relate to our inability to prosecute commercial crimes, our inability or our lack of success in prosecuting corruption, money laundering cases, and I think that may come to bite us when we submit the reports. So, Chair, on the timelines, we've got to submit a report to FATF by October this year. We hope to complete our portion of the report by around August, September. FATF will then have 6 months to evaluate where we have mediated and where we still come short. And then around March, April next year, they will then make a finding. There is a probability that South Africa could get grey listed. We as a country are doing everything in our power to avoid that, to fix the things that are needed. But there is a probability that South Africa could get grey listed. We're certainly hoping that on the banking side and the financial sector side, we have got all our areas covered. And if there are any adverse findings, that it doesn't cover the financial sector, but perhaps may cover other parts of the criminal justice sector, Chair. Thanks.
Governor, I will then respond to the data gaps issue. So the data gaps that's referred to are the grey areas in the heat map for the banks prior to 2008, and for insurance there's a gap prior to 2014. I think the main reason for this is really when the regulations change significantly and more information is gathered from banks, it makes it possible to extend and and improve these indicators. So in 2008, that would have been when Basel III was introduced. And then in the insurance sector, we had the introduction of the SAM framework. So that could explain, as I said, the heat map is a set of numerical ratios with a historical, through a historical lens. So it's in relation to history. Obviously, then if there's no history, you can't really have, indicators. That said, the heat map is something that we are continuously improving. So even the way it looks today may be different in 2-3 years' time. We are continuously looking to expand it. There are some sectors that don't reflect clearly. So I think it's a living thing for us. And yeah, we use it as a basis from which to start digging deeper if anything is flagged there. Thank you.
Thank you very much, Nicola and colleagues. The question on bond market liquidity, let's be clear. We got involved in the South African government bond market in 2020 because we were concerned about market dysfunction. We are not the ultimate provider of liquidity in the bond market. Liquidity is provided by the players in the market. We get concerned when there is dysfunction. And when there is, why would we then get involved when there is dysfunction? Besides the fact that the other markets which price credit in this economy, whether it's the corporate bond market and the Lords, use the government bond market as a benchmark. So if there is a dysfunction, those markets cannot function either. Secondly, our own monetary policy operations work on the basis of a collateral. If there is a dysfunction, how do you price that collateral? If you can't price that collateral, it poses thus a risk to the implementation of monetary policy itself. And so we get involved, and we were clear that we could be on either side. We could be buying the bonds, or we could be selling the bonds, depending on the extent of the dysfunction. And so we do not have criteria of when we would get in, except that when we see there is a dysfunction. This dysfunction might be taking place because people are reluctant to quote prices in the market and so forth. But since we started doing this, our own bond holdings have remained fairly constant. Although the liquidity has declined, the market is continuing to function. So you might be wanting to have lots of liquidity, which is good, and but to the extent that liquidity has declined, but the market continues to function, that is no big deal. Remember liquidity, and we will drill into this so that we get to the understanding of these things. To the extent that you have got investors or buyers in the market who will buy the bonds to hold to maturity, it will affect the liquidity in the bond market because these investors do not actively sell or buy their bonds. They buy them and they hold them to maturity. So yes, we worry about the decline in liquidity because deeper liquidity means that the price discovery mechanism is actually a lot more efficient. But we are not the ultimate provider of liquidity. Liquidity is provided by the interaction of buyers and sellers in this market. And of course, yes, it does get affected by the microstructure of the market. And I don't think we have seen any significant changes in the South African market microstructure that we think had necessarily affected the liquidity. But we will continue to watch the liquidity and the decline thereof, and to the extent that it poses a market dysfunction, that is when we come in to make sure that the markets continue to function. Fundi, Rashad, anybody wants to add anything on the bond market liquidity and functioning? Nothing? Okay, Samson, thank you very much. There is nothing further from the panel. Let me thank you very much for your facilitation and thank everyone for their attendance at this Financial Stability Forum. The review is available. It's got fairly rich information. Please continue to engage with it. Back to
Thank you, Governor. Thank you, Governor, for the closing remarks. I think what you have mentioned is the outstanding information that we want to give to our viewers, that the Financial Stability Review is available on our website. And also, we just wanted to extend our thanks to the participation of the media and our panelists. Thank you very much.